Hey gang, it's Walker Dybel, author of Buy Then Build and creator of the Acquisition Lab. Um, During my many years buying companies, and now I spend the majority of my time actually advising buyers and sellers. Sometimes it'll come up on the buy side in regards to how do I think about these certain liabilities that the seller has on their balance sheet, and then I come to figure out that it's really sort of a question around asset sale versus stock sale. Okay, and once you understand the structure, I think a lot of it starts to make sense. So let's understand what the difference is between an asset sale and a stock sale, and why you would want to do certain things in them, or make certain decisions around them. So the selling entity, the selling business, okay, is a legal entity, okay, and this legal entity, is liable, for any sort of legal things, and it's sort of the legal entity that pays taxes and reflects ownership of the company. It's the stock in this legal entity that is owned, right? But this legal entity owns a bunch of assets inside of it, okay? Now, these assets can be tangible or they can be intangible. And what I mean by that is a tangible asset might be, a printing press, or, a powder coat oven, or, some, big physical industrial piece of equipment. Intangible is going to be, the brand, the logo, frankly, the culture of the people, the sort of standard operating procedures, the intellectual property, the website, all of these kinds of things. And the truth is that the legal entity in and of itself doesn't actually generate any cash, does it? It's the assets, okay? It's the assets that generate the cash, right? And so it's ultimately the cash flow and the assets that you're after. And whether or not you want this blue legal entity is usually dependent on just a couple of things. But let me say it like this. Almost all lower middle market and Main Street transactions are going to be an asset sale and not a stock sale, okay? So an asset sale is where you form your own legal entity, okay? And then we're going to move all of these assets and all of this cash over into your legal entity, leaving this one hollow, okay? So in other words, we would have this cash flow that, of course, is coming from these assets. Don't make fun of my drawings. I know you're thinking about it. And what we did was we moved them from here to there, and so this, of course, is now a hollow legal entity, okay? And that's it. And sometimes it could be that, this legal entity over here, maybe there was, a building or something like that it owned, and that was a asset that this company didn't want, right? Something like that, in which case this building should be black. Maybe this legal entity still owns a building, or a separate online business it had, or something like that. More common than not, it's actually left empty, and then this is a shell of an entity that the seller, they might accept a seller note or something like that. They might leave it open to start a new business. Oftentimes they'll kind of shut it down, okay? And then that legal entity is gone, and you've moved all of the assets and all of the cash flow, things that generate cash flow, over here. That includes employees and all the rest of it. Usually you have to terminate them from this legal entity and hire them on that legal entity. Usually done in the days following the transaction. Listen, the reason this is beneficial, it's a cash-free, debt-free transaction. Okay, so let's write that down. Cash-free. What does that mean, Walker? It means that any cash that was in that original entity, okay, is retained by the owner. Okay, so any cash that was in here, any cash balance is retained by the owner. So that would be, I had $1 million in cash. Well, I'm going to take that cash and then I'm going to sell you these assets. Okay, so cash does not move over. The other thing would be liabilities. So it's debt free. Okay, debt free. if you made fun of my drawings, you will also be making fun of my handwriting. So I had $1 million in cash, and I had 250,000 in debt. I keep my debt. I keep my debt if I'm the seller, and you as the buyer don't accept any of the cash or any of the debt. Okay, and so why does this happen? Well, it really is to the benefit of the buyer, okay, because it limits the sort of like historical risk of the original legal asset. So, let's say you buy let's say you buy the stock of this company, okay, and now you as the owner are liable for the entire history of this entity, okay? So, you buy, Whiteboard, Whiteboard Manufacturing Corporation, and you buy the stock, okay? And then 4 years after you buy it, a bunch of toxic waste barrels show up in the Pacific Ocean with Whiteboard Corporation printed on the side of it, or there was a bunch of bad product that failed. Okay, you're now liable because you are the owner of this legal entity. When you buy the assets and not the legal entity, you are not liable for anything that did not happen on your watch. Huge benefit to a buyer, and the core reason why most of them happen that way, and that is the default setting. The other reason, okay, or I'm sorry, let me say it differently. The reason why you would do a stock sale is typically because of, there's some kind of contract, or, a supplier contract or a customer contract or some kind of license that is very that is non-transferable, that is essential to the business. Okay, that's probably number one reason. Number two would be, obviously, if you are investing in a minority role, okay, like say a startup or something like that, you're buying equity. And the third would be, once you get into sort of larger deals, it becomes easier and slightly more common to do a stock sale. But it might be like if the seller is going to stay on and continue to retain, let's make it up 20% of the business, and you're going to buy 80% of the company in sort of a private equity situation. There might be a reason in this structure to do a stock sale. If you, as the buyer, decide to buy it as a stock sale, it has tremendous tax benefits to the seller. And so as a result, what almost always happens is that the purchase price, okay, if I'm going to buy a purchase price on assets, okay, it's usually higher than if you buy it with stock. And the reason why is because the cost of the purchase price tends to be worth more to the buyer, to the seller. So bad example, but just to make an example, let's say I'm going to buy a company for $100, and after taxes, this person is going to get $65. Okay, well, if I buy this company for $100 as a stock sale, then this person might get $75. Okay, and so and by the way, if you buy a Canadian company or an Australian company or anything like that, these have drastically different impacts, to the point that a lot of them say at first that it's gotta be a stock sale, right? And so in essence, this gap between the 75 and the 65 is not lost on the buyer ever, okay? And they know that this is worth more to a seller, and so they will very often say, well look, if I spend $100 here, or if I spend, I can't do that math in my head, but let's just say $90. If I spend $100 as an asset sale or $90 as a stock sale, it ends up being worth the same to you, okay? And so that doesn't exactly transfer. The only other thing that I want to add is that when you do an asset sale, you might say, well, I bought Whiteboard Corporation, but my LLC is called Walker Deibel Corporation, so how on earth does that, I can't name it the same thing, right, legally. And so all that happens is that this new asset that you buy has a doing business as, you file a DBA with your state government, and it's just that simple. You file it online, it's like $10, and then you have to re-up it, I think, every 3 years, something like that. Listen, thank you so much. Listen, when I first went out and tried to buy a business in 2004, I failed There was no good information. There was no good instruction. It was an opaque private marketplace that I had to navigate, very fragmented. And along the way, I ended up acquiring 7 companies. I've acquired $16.5 million in revenue over a 10-year period. And I ultimately, wrote Buy Then Build as sort of like, what I learned kind of walking that path. And it was always sort of my dream to ultimately create some kind of, world-class instruction around this. And it wasn't until readers started asking me to help them find and buy a business that I was like, that's crazy. I can't do that. Like, I can't charge you enough. It's way too hard, and I can't guarantee results. And so what we did was I recognized that really there was a you could sort of do it yourself, like buy a copy of Buy Then Build, go out and buy a copy of the Harvard Business Review Guide to Buying a Small Business, and sort of go out there and do it yourself. Or you could hire a buy-side advisor for $5,000 a month plus a double Lehman success formula, which would be about on average about $150,000 extra expense to a buyer. Okay, well, if you're an acquisition entrepreneur, why would you increase the cost of your transaction like 15% to bring on someone that's not doing anything that you can't do? A lot of us search as full-time or heavy part-time, right? And so ultimately I created the Acquisition Lab. And the point here was to build world-class instruction, a suite of tools, and ongoing coaching so that we could provide assistance on the subject you needed when you needed it, rather than just have a pre-recorded online course that you had to go back and dive into. I wanted to do all of this through a vetted community that we made sure that everyone that was accepted would actually be able to acquire a business, right? They've got this sort of like business sophistication, or the kind of drive to do so, and also just has access to at least a little bit of capital in order to get that done. We did that. It's called the Acquisition Lab, and what I didn't expect was that the vetted community would take off in the way that it has. It's such an impressive group of people. It's such a thriving community. And if you are looking to buy a business in the next 6 to 18 months, we created the Acquisition Lab as a do-it-with-you buy-side advisory service. And it's offered all at the cost of less than 1 month of a buy-side advisor with lifetime access to you. If you have interest in joining us, we run cohorts every so often. Please go to acquisitionlab.com and apply. I look forward to working with you soon. Thanks.